Okay, so extractor call was something that we began last time, and we just did the cash flow from operating activities. Now we're going to go ahead and do the cash flow from investing activities. And I didn't leave a whole lot of room. I'm going to try to write most of this in the margins. And you do have to kind of flip and forth, back and forth between the balance sheet and the income statement in order to make sense of this stuff. So looking for the investing activities, of course, I want to hone my gaze on those guys because they are my long-term assets, right? Plant assets, accumulated depreciation, land. And that's where I want to focus. I could have something exchanged for a note, but that would be classified to you, I would say, we purchase land with a note payable, and that would be what we call a non-cash transaction. But there's none of that in extractor clause. It's a pretty simple and straightforward example. Remember, I can't just look at this and say, oh, well, this increased by $40,000, so I bought a plant asset worth $40,000. No, that doesn't work because there could be numerous things to give me a $40,000 increase. We have to analyze it and see if that is true. In this case, it looks to be true. But again, we have to make sure that there's nothing squirrely going on here. So the plant assets go from $300,000 to $260,000. One thing to check is if we sold any plant assets, right? If there had actually been a sale and a credit here, then accumulated depreciation, this account would not balance with just depreciation expense. So let's look at that, 75 to 85. Okay, and then I go and grab my depreciation expense of $10,000. Remember, that's going to end up as a credit here because we debit depreciation expense and credit accumulated depreciation. Well, that balances perfectly. So there is no sale of something that is depreciable, which means that this entire $40,000 must have been a purchase in this case. Right. The other thing, of course, we may see is a gain, that would obviously tip us off on a sales if there was a gain or loss on the sale of plant assets. But just because one isn't here doesn't mean we didn't sell one, because we could have sold one at a book value, right? At its book value. Right? So we have a purchase of plant assets. And that is a cash inflow outflow, because we purchased one, be careful, of $40,000. Then we look at the next item, land. Land went from 35 to 25. And again, we can't just say, oh, we must have sold land for 10,000. Not necessarily. It may be the case, but it's not necessarily going to be the case. So we have 35,000 and 25,000. If that is the case, then we would have had land that was sold for 10,000. We would have had a loss on that sale because we did definitely sell some land for 3,000. And if we ate a loss on it, then that must mean that the cash we spent was, the cash we got for that sale was 7,000. So I would write sale of land. $7,000. And then there are no other investments, so there's nothing else that could be accumulated here. We have a net cash from investing activities. It's going to be an outflow of $33,000 in net. Right. So now let's look at the financing section. Right now, I put my focus on long-term liabilities and equity accounts. So the cash flow from financing activities, I have bonds that went down by 8,000, and really for the liability accounts, it is as simple as a cash inflow or outflow. Now you just have to figure out, well, if my bonds went down, then I have a cash payment because I'm paying down my outstanding debt. So I would have a retirement of bonds for 8,000. That's a cash outflow. Okay, in this case, because the debits are going to be cash outflows and the credits are going to be cash inflows, we're not worried about, it's not like land and plan assets and other investments where the right side of the T account definitely represents the historical cost in the case of assets, and the left side definitely represents cash in the case of these assets as well. On this case, now, again, we're making the simplified assumption that both sides are just strict cash amounts, so it matters a little less that we know for sure that that was just a one-way transaction, that it wasn't, for example, me issuing 10,000 more bonds and then buying back 18,000 to get a net of -8. Common stock, APIC, both went up. Common stock went up 30. APIC went up 83. And both of those together then would be $113,000, and that's from a stock issue. So we got a lot of money from that stock issue. The last thing you always want to do is check retained earnings. Just like you check the accumulated depreciation to see if there was a sale, make sure that this reconciles with the information you have about net income. So I have retained earnings started at 45,000, ended at 49,000. So I did my T account, and then I incorporate my net income information. Well, then that doesn't balance, right? 45 plus 9 is 54. So I must have declared $5,000 of dividends. Now, remember, this is declared dividends. I didn't necessarily pay them. In order to check whether I paid them, I would need to see if there's any dividends payable accounts. Well, there isn't a dividends payable account recorded. So I must have paid everything I declared. So that is, dividends payable would have increased by 5,000 on this declaration. And since I ended up with a $0 balance, I don't have an account outstanding. I must have paid all these with cash. All right, so I paid dividends of $5,000. That is a cash outflow. And that means that overall then I had net cash from financing activities of 100,000, and that is an inflow overall. All right, so that is a pretty simple financing section and investing section. A more complex investing section would have something that happened to my plan assets, because if something happens to plan assets where I actually sold some, then accumulated depreciation is affected. A more complex financing section might have an accrual of dividends payable, so that you have to reconcile this a little further and understand that declared isn't necessarily paid. And so there are small things that can go in there to make it a little bit more difficult. So stuff to watch out for. I just made a little list of things that tend to give people problems. But with a bit of help or with a bit of practice, these shouldn't really be that big of a deal. Non-cash transactions is something kind of big. Sometimes we'll issue stock for a fixed asset or a note payable for a fixed asset. Sometimes we will sell an asset So not purchase one, but sell one for an entitlement to be paid later. So that's a note receivable. These do not represent investing. Well, back up. They do represent investing activities, but they do not represent investing activities that involve cash. So for example, we might issue stock and get land in return for our stock ownership. You know, say we just get $100,000 of land and we issue a certain amount of shares. Well, see, obviously cash doesn't enter this transaction. So you would have an increase in common stock that has no cash. So this wouldn't be part of your cash flows from financing activities. This is an inflow of an asset that it would look like an investing activity, a purchase of land, but it was purchased with common stock. So whatever amount of land you purchased, you would have to back out this $100,000 because it's non-cash. And of course, like I said, this can be done with a note payable. We have land, $100,000, and we have a note payable for $100,000, right? So in this case, again, this looks like a financing activity, but because this isn't a debit to cash, it's not a cash flow financing activity. This looks like an investing activity, but because we didn't pay cash, it is not a cash flow investing, right? So if these come up, you just have to write a journal entry for them, or I'll provide one for you, and then you back it out of the cash transactions that occur. So, in this case then, for example, say we had land, and land went from, I don't know, it was at 200,000 and it eventually went up to 400,000. And I tell you, we didn't sell any land, right? So if we don't sell any land, then we also had this non-cash transaction. Well, 100K of this would be non-cash. And then if I don't tell you anything else, you would assume that the other 100K was cash. Okay. So it's just using this and then informing your T accounts a little bit more based on whether or not this was a cash or non-cash transaction. Also, sometimes there would be, convertible bonds or stocks. If they can be converted, then increases and decreases resulting from these transfers are not going to be cash flows from financing activities, because you're increasing your debt because a bunch of people converted their stock, or vice versa, not because you got cash or paid cash. Gains or losses on the sale of assets. Remember, there's going to be two places that this will ultimately fit in. It'll fit in when you're writing out your journal entry for the sale, because you're always going to have some sort of a gain or loss on this, right? Unless that equals out directly, then any sale is going to have a gain or a loss if it's a debit, a gain if it's a credit. And so it informs the investing activities, but you also have to reverse it in the operating section. It's necessary to prevent double counting. Okay. Changes in dividends payable, don't blindly pass through and put this in the operating section. Remember that this will tell me about how much I actually paid in dividends after I determine how many were declared. And so again, the big thing to remember here is that when you're talking about the dividends payable account, what does a debit mean? What does a credit mean? Well, credits will mean that I have dividends declared, and debits will mean I have paid dividends. So that's how the account increases and decreases. And then from there, it's just a beginning balance and an ending balance, and figuring out, where does the dust settle after that. Changes in available for sale securities, we will revisit in Chapter 12. The interesting thing about these is that if we have an unrealized holding gain or loss, their value will increase on the balance sheet or decrease on the balance sheet depending on whether it was a gain or loss in their holding value. But since we haven't sold them, this is not something that represents a cash transaction. And if there is a change in this, remember they are OCI items. So it doesn't affect net income. We don't have to back it out of cash flow from operating activities because it's not in net income. And as a result, we're only going to record something when we actually sell them, and they would be sold. And then when we do sell them, it would be in the investing activities section. And then when we purchase them, they would be in the investing activities section. Don't worry too much about these. We'll revisit them in Chapter 12. I don't expect you to, grasp not only everything, that is a review of intro and even a little bit of an extension of your knowledge of intro in terms of an application. And then also this new information. I just bring it up now so that when I refer to it again in Chapter 12, you might be thinking, oh, that's right, he did talk about this. Same thing with trading securities. Trading securities are even more interesting. And by interesting, I mean counterintuitive with how we classify them in the statement of cash flows. Mark-to-market effects are included in earnings. So unrealized gains or losses increase and decrease their value on the balance sheet. And this also gets reported in net income. So we do have to back it out of the operating section. So we have to subtract out gains, add back losses. And so because it affects net income, we have to make that adjustment or else we're going to double count. If we buy or sell trading securities or securities that we classify as trading securities, then the purchase would be a cash outflow from operating activities. The sale would be a cash inflow from operating activities. Right? And then we'll work through these in class. This is just more journal entries that are converted to understanding how they affect the statement of cash flows.